I'm a betting man, and I'll wager that you're sick and tired of paying commercial insurance carriers huge annual premiums while they just pocket the dollars that they don't spend in claims. It has to deeply anger you that your insurance carrier is earning compounded investment income year after year on your money. Do you want a program that in the first year, right off the bat, you can pay 15 to 18% less than you're paying right now, while earning compounded investment income from day one? Have you ever completed a good year from a claim standpoint, only to have the insurance carrier to smack you with a rate increase at renewal and then blaming the market? As Dr. Phil might say, well, how does that make you feel? You probably feel that money is being flushed down the toilet, and it's actually not. It's going into the pocket of your insurance company. This can really ignite anger in your gut, and it should. If you want to start building equity through your insurance program and reap the rewards of your own underwriting profits, exactly like your insurance carrier does, then it's time for you to give a hard look at commercial group captives. Buckle up, as you are about to quickly discover why over 5,300 middle market American businesses, once in your shoes, have already upgraded to the superior insurance program. In about 9.5 minutes, I will demonstrate how this model works and the prerequisites to take this next step for your company. And I highly encourage your CFO to sit in as co-pilot for this endeavor. I'm Shane Neal with Brown & Brown Insurance, representing the 6th largest insurance brokerage in the world. This is not our first rodeo, and we have the knowledge, access, and understanding of all aspects of offshore group captives, which I will illustrate are hands down the best commercial insurance options for well-run businesses that qualify. What is a captive and why? I can't stress enough that this is not for everyone, and there's a fairly good chance that your business may not qualify, as this is only for well-run, financially stable companies that are committed to safety. All businesses considered shareholders once they join are enjoying all the benefits that your current casualty carriers profit from. To really grasp the concept, it's important to have an understanding of how your carriers really make their money. It all revolves around the 20-60-20 rule. Within the book of any typical casualty carrier, 20% of their book of business makes an underwriting profit. These are deemed good accounts. 60% remain relatively flat over the course of a few years. And the last 20% of them have losses that exceed their premiums. These are considered unprofitable or bad accounts. The insurance companies basically strive to break even, which, using their own insurance jargon, striving for a 100% or below combined loss ratio. They really make their money on investment income. Group captives are only for that top 20% that have been paying for the party, allowing for the bottom 20% to drive up the rates of everybody else. In fact, the 5,300 business owners that have moved their casualty lines offshore have created adverse selection, which further drives up the current rates in the standard market, where your business is placed. Is it risky? There's a lot of confusion and uncertainty about group captives, and those that dismiss them clearly are intimidated by their complexity, or they just don't understand the captive model. Group captives are structured just like your insurance companies are, with the backing of an A-rated carrier, reinsurance limiting the maximum loss exposure, and your own umbrella policy providing additional protection for you. This is a third-party offshore group captive. Third party because the offshore manager is in charge, wiring you your annual distributions. This is absolutely nothing to do with micro captives or 831Bs. This is not only a safe, secure option, this is where the best, most well-run companies have already moved to, and where the best risks that still remain onshore are headed soon. The Cayman Islands isn't just a tropical paradise and one of the best blue marlin fishing destinations in the world. It's the financial epicenter for group captives. Georgetown is the capital of the Cayman Islands, boasts over 700 filed captives, writing an aggregate $15.6 billion in premium and managing $66.2 billion in assets. There's a reason that 40 of the world's top 50 banks and Big Four audit firms have jurisdictional presence here. In fact, 90% of Fortune 500 companies actively finance using a captive structure. What does this tell you? And keep in mind, all the premium dollars from shareholders accumulate completely tax-free while they are offshore for the life of the captive. Because of this, the Captive Investors Fund can achieve much higher returns than they can onshore. So how does it work, and who can qualify for the program? The insurance lines that can be considered for the group captive are the three main casualty lines: workman's compensation, general liability, and business auto. Each individual filed captive has its minimum annual premium requirement for one or a combination of all of those three lines. The absolute minimum entry level is $150,000. However, the sweet spot in our analysis and case studies have shown that at $400,000, there are more captive options available, and the larger the premium entry level, captives tend to statistically outperform smaller ones by a small percentage. Let's talk about who the players are. Each shareholder is assigned an onshore captive manager domiciled in the U.S. and an offshore captive manager in the islands, either the Caymans or Bermuda. The first step of the process is having the onshore captive manager qualify your business from an underwriting standpoint. They require 5 years of your historical and current losses and the last 5 years of premium. These are used to establish a loss pick required to determine if you qualify from a loss standpoint. Once the underwriting side is approved, the second step is having an offshore captive manager approve the financial stability of your business, and will require either a reviewed or an audited financial statement to do so. Am I a candidate? Can I qualify? If your business has around or below a 45% 5-year average loss ratio with one or more of the three casualty lines, work comp, general liability, or business auto, and currently pay a minimum of $150,000 in annual premium and one or a combination of those three casualty lines, then there's a good chance that you will qualify. And keep in mind, if one or more catastrophic losses claims over $100,000 are driving that loss ratio, it can be an even higher percentage than 45%, as frequency is scrutinized much more than severity in the underwriting process. How do I know if it's a better option than what I have now? I know all this sounds good, but how would you know if this is really the best option for your business and better than the programs that you are currently on? I'll tell you this, in the initial year of joining a captive, you typically pay 82 to 85% of your current program. Can you pay more in your first year? Absolutely. If you have a large influx of claims frequency than you have had historically in the past 5 years, then yes, you could have an assessment. However, there is a stop loss that we can illustrate for you that is the worst case scenario, so you know what you're looking at up front. In contrast, if this horrific frequency year occurred in the standard market, you would most likely receive a non-renewal, a 45-day notice of cancellation, or if we have to move you, a huge rate increase if we can rewrite it at all with another carrier. At Brown & Brown, we can take it a step further and can illustrate the what-if scenario. Once the offshore and the onshore captive manager have determined that you're a qualified candidate, then we can use the 5 years of loss runs and historic premiums that you have submitted and furnish you with an illustration that shows exactly the savings you would have received had you been in the program for the last 5 years. We can illustrate this comparison to any product you are on for work comp. We can compare it to a guaranteed cost, sliding scale dividend, retrospective rating program like an incurred loss or paid loss or large deductible. If you qualify, no other program can beat this one, and we can prove it to you. Here's an example of just that, the what if scenario. Your CFO or CPA will want to pay attention to this and they're going to love it. This account was placed in a group captive on March 1st, 2021, and this is the document that shows exactly how the captive quote on the table would have performed against the standard market program had they pulled the trigger in March of 2016. As you can see, the insured had a poor year in 2016 with almost $1 million in claims while paying just over $800,000 in premium. That's over a 110% loss ratio. They had a couple of good years as well, in 18 and 20 respectively. In 5 years, this business would have saved over $1.9 million had they pulled the offshore trigger back in 2016. That is conservative as it doesn't even contemplate the investment income returns. This is an example now of many Brown & Brown clients building equity through their group captive insurance program. Now buckle that seatbelt a little tighter and direct your attention to this bad boy. This is an example of 2 equity statements found in the board book of a group captive program, which we have combined onto one page. Each column represents a shareholder. Just look at the amount of equity each of these members have grown through the program cycle. Focus your attention right here. Shareholder number 50094 had a $260,518 in frequency claims and still earned $509,768 in positive equity. That's a 45% return of total provisional premium. How much equity have you grown in your current casualty program? I can tell you, it's zero. You don't have to be a rocket scientist to see that these businesses are acting just as the carriers do and reaping the rewards of their own underwriting profit, all while earning compound interest income from 6 different access points. If you would like to see if you are a qualifying candidate for this program and see how much premium dollars you have squandered over the last 5 years, contact me now. I highly encourage you to bring your CFO or your CPA when we present the program. This is typically more numbers oriented and they may see the benefits more clearly and will greenlight the move. If you don't qualify, we can help you to eventually reach the offshore promised land. And while doing so, can certainly provide you with detailed comparison of your current standard market program against the best available. We have all the top standard markets to do just that. If you meet these requirements and you don't want to look at this option, then I don't know what to tell you. Perhaps you don't like money.